can say the sentiment here in Silicon Valley feels nothing like what the stock market looks like within tech. It still seems incredibly vibrant. But I do think when we think about can this trade continue, we have to really look at what's happening right now with multiples. We've had a really nice move in the market so far this year. It feels really nice after last year. But I think we're going to be limited in terms of the multiple that people are willing to pay in this environment where interest rates are still rising. So we've had such a strong jobs number recently that I think the Fed is going to continue raising rates. And so I think that's going to continue to put a lid on valuation multiples. So it's just hard to argue for a lot more expansion from here. But it certainly has been nice to see, somewhat of a recovery here in stock prices. And many tech names, not the big, large cap tech names, but many have been down 70% or more. And so I think some of that was just overdone. So nice to see a little bit of a correction here. But it's just really hard to make a case for ongoing improvement from here in terms of stock prices.
Weiss, I got the 10-year at 372. Long duration assets, so-called long duration assets have been hit as rates have gone up. Did we put a cap on that trade that had gotten off to a great start this year? Because I'll give you some numbers of stocks this week alone after you answer that question. Yeah, so I'm still short. I'm still long TBF, which is short the longer end of the curve because I think rates still do go up. Look, this has been driven 100%, 1,000% by multiple expansion. And as I said before, that in a rising rate environment where the brunt of the Fed activity, the Fed tightening, has yet to be felt at all, really, it's a bad time to do it because you're not at trough earnings yet. That I don't mind multiple expansion. So, look, do I think it still has some more legs? Yeah, I think this is a good reset. Tech, specifically on this growth trade, you think it has more legs? Not right now, but I think it'll come back to it because there's an insatiable appetite to buy. I don't think it's the right move, frankly. I think you still want to be mostly in cash at this point because the second half is going to be miserable when you see the impact. But there'll be opportunities. I mean, you take a look at where Microsoft is, and that's come down from the highs. And you take a look at some of the others. Well, I'm going to give you. You take a look at the semis, which have been, incredible to run there, and they shouldn't have been. So you've had this money come in. You've had the post-tax selling season buying. You've had this euphoria about the beginning of the year, and then you had the FOMO, of which plead guilty to the end of it. But, yeah, I think that the risk is to the downside. I mean, in 5.5 weeks, Bryn, I'm just going to give you an idea of names that have run a lot. Meta's up 48% in 5 weeks. Coinbase is up 64%. Shopify up 39%. Teladoc up 39%. ARK up 27%. So I give you year to date, but then I also tell you what we've done this week because it maybe tells the story that we ask at the top of the show of whether the trade is rolling over, okay? This week, Coinbase down 22%. Shopify's down 9%. Teladoc's down 6%. ARK's down 7.5%. What do you think about that broader question of whether this euphoria that was all around this early tech trade is about to end?
So investors need to understand that on any day, 80 to 90% of the volume can be algorithmic trading or CTAs. And we had a massive, massive short covering at the beginning of the year, which put so much energy onto those exact names you just mentioned. So some of those names maybe got overdone, like a Facebook saying we're going to cut spending. Maybe it deserves to be up, I don't know, about 30% in one day or 25%. But here's what you need to understand. Stocks tell us what they think about the economy, and stocks are pricing in no recession, soft landing. Bonds, though, drive stocks. And within the bond market, the 2-year is what you need to focus on. And so you can put this rally in high beta tech, overlay it with the 2-year, which has gone from November from about almost 470 down to the third week of January, almost 4%, maybe 405. And then where are we today? 450. Because guess who follows the Fed? Fed funds follows the 2-year. Fed funds follow the 2-year. And so I still think that although the Fed has come out and said they're data dependent, which is a plus, because they're not so behind inflation, we are still, I think, at the mercy of the market saying, well, maybe Powell has more rates, and the cuts that were in the market earlier this year are now off the table. That's what's driving what's going on in tech and high beta tech. I
mean, the poster stock of all of this is Tesla, isn't it? Which you own. I mean, it was at $100, right? And it's at 200. Okay. So in a few weeks, it went from 100 to 200, and today it's down 5.5%. So was that too far, too much too soon, as Adam Jonas of Morgan Stanley is wondering today?
I think 100 was too low. I think it was too much too fast of the really jump off the cliff as he decided. Maybe he tweeted he was going to buy Twitter, and then he actually had to buy Twitter, right? That totally destroyed sentiment and positivity. As that starts to go away, and that he did the price cuts in China, which is incredibly smart, because as much as we talk about EV sales in the U.S., globally EV sales in the U.S. is 9%. Europe is 24%. China is like 50 to 60%. And so he is really gaining traction in China. And so I think that is what people are seeing, is that was really smart to cut those prices. And so, yeah, it went from 100 to 200. It should have never been at 100. But maybe this is now the new price for it. It needs to digest itself. As you know, I bought it at 120, but I sold calls at 150. So I'm capped out at 160 because I got $10 because I thought it's going to take time. But that's what the market does.